Welcome to this lesson. This is partnership. Today we are going to look at admission of a new partner. So when a new partner is admitted, the following changes are made. Number one, the new partner introduces capital to the business. And this capital may be in form of cash or it may be in form of an asset. Number two, the new partner may be required to pay for goodwill. So in some cases, the goodwill is not paid in cash. In other cases, the goodwill is paid in cash. Number three, a new profit and loss sharing ratio is determined. Every time there is admission of a new partner, the profit and loss sharing ratio changes. So here is a definition of goodwill. So we define goodwill as the reputation earned by the business through hard work, honesty and quality, and satisfactory services to customers. So goodwill is an intangible asset that has value. So if the business can attract more customers because it has a good reputation, it means that the business will generate more profits because of having a good reputation. So goodwill can add value. It can bring value to the business. So therefore, it can be valued in terms of shillings. So this is one of the ways goodwill can be determined. So keep in mind that there are many ways to determine goodwill, and partners usually agree on which method they are going to be using to value the goodwill. So goodwill allocated to a partner is equal to total goodwill in the business multiplied by new partner's profit sharing ratio. So total goodwill in the business. This is goodwill in the entire business. This goodwill is supposed to be shared by all partners according to their profit sharing ratio. So if a new partner is admitted, they can be required to pay goodwill. So the amount of goodwill they can be required to pay can be calculated using this formula. They're not going to pay the full goodwill of the business. They are going to pay their share of the goodwill. So goodwill in a business is determined by its profitability. Firms use different methods to determine goodwill. So the more profitable a firm is, the higher the value of the goodwill. If the business is making losses or if the profits are very low, it means that the value of goodwill will also be very low. So now we are going to look at the accounting part. That is, when you admit a new partner in a partnership business, so what is the accounting aspect? We are going to look at the first one, accounting for capital introduced by the new partner. So when a partner introduces capital, we are supposed to debit the cash account. So this is with the amount of capital introduced. So keep in mind, we only debit cash account if the capital is introduced in form of cash. It can also be a bank account. If capital is introduced in form of asset, then instead of debiting cash account, we are supposed to debit the asset account. For example, a partner can bring a personal motor vehicle into the partnership business. So that motor vehicle will be used by the business for business activities. It will be counted as capital to the partner who has introduced it. So in such a case, we would debit motor vehicle account. So capital can be in form of cash or asset. So once you debit the cash or asset account, you credit the partner's capital account with the amount of capital introduced. Whether it is in form of cash or in form of asset, we always credit the partner's capital account. So something you're supposed to note is that the cash paid by the new partner should be separated into the capital part and the goodwill part. The capital part and the goodwill part should be recorded separately. So sometimes you are given the amount that the new partner has brought as one figure. For example, the new partner has brought 100,000, and that 100,000 combines the capital and the goodwill. So do not record the 100 in the capital account. Separate the capital part and the goodwill part. So it is only the capital part which will be credited in the capital account, the column of the new partner. So that is how we account for capital introduced by the new partner. Next, we are going to see how to account for goodwill. The accounting for goodwill depends on 3 factors. 1, where the new partner is not required to pay for goodwill. 2, where the new partner is required to pay for goodwill in form of cash. And 3, where goodwill is recognized but the partners wish to write it off. So we are going to look at all these 3 methods. So let us start with the first one, where goodwill is paid in form of cash. So if the new partner is required to pay goodwill in cash, these are the entries we make. We debit cash account, then we credit partner's capital account or the current account. So one thing you are supposed to note here is that when we credit the partner's capital account with goodwill, it is only the columns of the old partners. The new partner does not get a share of that goodwill. So it is only going to be allocated to old partners using the old profit sharing ratio. So that is the first scenario where goodwill is paid in the form of cash. So let us look at the next scenario where goodwill is not paid in cash. It means that the business or the partners have determined the value of goodwill in the business. They know the goodwill in the business, but the new partner is not required to pay any cash for that goodwill. In such a case, we debit goodwill account with total goodwill of the firm. Then we credit partner's capital or current account, and this is the old partners only. And we are using the old profit sharing ratio. So this part and the first one, where goodwill is paid in form of cash, they are similar in terms of recording the capital account. In both cases, we have credited the partner's capital or current account, and it is only for the old partners only. The new partner does not get a share, and we are using the old profit sharing ratio. So after that, we go to the third scenario where goodwill is to be written off. So for the goodwill to be written off, there must be a goodwill account. And a goodwill account is created in the second scenario where a goodwill account has been created. And a goodwill account is created in the second scenario where goodwill is not paid in cash. So in that case, when the goodwill is to be written off, these are the entries we are supposed to make. We debit the partner's capital or current account. This time it is to all partners, including the new partner. Instead of using the old profit ratio, here we use the new profit sharing ratio. So that is the difference between writing off and recognizing the goodwill. And then after you debit the partner's capital or current account, next you credit goodwill account with the total goodwill written off. So those are the entries we make in different scenarios. So one thing you're supposed to note is that if the partners use the fixed capital method goodwill is recorded in the current account. So as you can see, in each of these scenarios, in each of these three scenarios, we are recording either to the capital account or the current account. So how do you know whether you are supposed to use the capital account or the current account? In most cases, in an exam case, if you are given both the capital account and the current account, we normally record goodwill in the current account. We only use the capital account to record the fixed capital. If you are not given a current account, maybe the question does not show a current account, you can record goodwill in the capital account. If the partners use fluctuating capital method, that means the capital is allowed to fluctuate, then you can record goodwill in capital account. But according to our note below, if the partners use fixed capital method, then you cannot record anything else in the capital account apart from the capital that was introduced by the partner. In the fixed capital method, all other things should be recorded in the current account, except the capital introduced by partners. Whether it is in form of cash or in form of asset, whether the old partners have introduced more capital in addition to what they had, all capital introduced is recorded in the capital account and nothing else if we are using the fixed capital method. So those are the entries you're supposed to note, especially for exam cases. And here we have an example. So the example says Jack and Nina are partners sharing profits and losses in the ratio of 2:1 respectively. Their current account balances are Jack 1.6 million and Nina 1.2 million. On that 1st March 2021, they admitted Maria to the partnership. On admission of Maria, the profit sharing ratio changed to Jack 7/15, Nina 2/15, Maria 6/15. For purpose of admission, goodwill was valued at 12 million and was written off the books immediately. On 1st April 2021, Maria paid 5 million shillings, which comprised her fixed capital of 3.5 million shillings and her current account contribution of 1.5 million shillings. So in this case, Maria paid a total of 5 million, but that 5 million was divided into two. 3.5 million was fixed capital and 1.5 million was current account contribution. So we are required to show the accounting entries for goodwill on admission of Maria. So let us see how we are supposed to account for goodwill on admission. So before you start showing the accounting entries, there are some few things you're supposed to ask yourself. One thing is the goodwill introduced in form of cash? Is the new partner required to pay goodwill in form of cash? So note that Maria paid only 5 million. And out of this 5 million, 3.5 is fixed capital, 1.5 is current account contribution. So if this is the only amount Maria contributed, then we can say that Maria did not pay for goodwill in form of cash. So therefore the entries we are going to use are the ones we have said goodwill is not paid in form of cash. So those are the entries we are going to use, and at the same time we are going to write off the goodwill immediately. So if we go back a bit, there were those entries where we said where goodwill is not paid in cash. Those are the ones we are going to use. And then again, we are going to use the other ones where goodwill is written off, because in this case, the goodwill is also written off. So these entries will be recorded in the current account because we are told that Maria had a fixed capital. So anytime they mention fixed capital, it means we are not supposed to alter that capital. And if you're not supposed to alter the capital, we cannot be recording goodwill in the capital account. So we can only record goodwill in the current account. So the first step, we are supposed to start by recognizing the goodwill before writing it off. First, we recognize the goodwill. So remember what we said. If the goodwill is not paid in cash, we are supposed to debit the goodwill account. We credit the partner's current or capital account. In this case, it is going to be the current account. So one thing we are supposed to note, I will take you back to the entries because it is very important you remember this. When you credit to current account, you are supposed to share that amount among the old partners only, and you are supposed to use the old profit ratio. So in the question, the old partners are Jack and Nina. The old profit sharing ratio was 2:1 respectively. So this amount of 12 million is going to be shared by Jack and Nina using the ratio of 2:1. So we are going to credit the partner's current account. Jack is going to take 2/3 multiplied by 12 million, which is 8 million. Nina is going to take 1/3 multiplied by 12 million, which is 4 million. So we have credited a total of 12 million and we have debited 12 million. So that is the first thing. We have recognized the goodwill. And then the second thing, they don't want to maintain the goodwill in the business. So we are going to write off the goodwill. And to write off the goodwill, let me take you back to the entries so that you can see what we are supposed to do. Where goodwill is to be written off, we are supposed to debit the partner's capital or current account. So note what we have inside the brackets. We said it is all partners using the new profit sharing ratio. And then we credit the goodwill account with the total goodwill written off. So all partners, we are going to have Jack, Nina, and Maria. The new profit sharing ratio, it is given here, 7/15, 2/15, and 6/15. So the 12 million will be divided using this ratio. So we debit partner's current account. Jack will take 7/15 times 12 million, that is 5.6 million. Nina will take 2/15 times 12 million, that is 1.6 million. Maria will take 6/15 times 12 million, that is 4.8 million. And then we credit the goodwill account with the whole amount, 12 million. So there is something you can note below here, that if goodwill is written off immediately, you can skip the goodwill account. You can skip the goodwill account. So skipping the goodwill account means, in the first case, you can just credit the partner's current account, 12 million. You debit the partner's current account with the total here, which is 12 million. Because the goodwill account is not going to appear anywhere, you can just ignore it. That is if you want to follow a shortcut. But for purposes of working, in exams you are required to show your workings. So you can also show all of them. So now that we have determined the amounts we are going to debit and credit, let us now record them in the current account. So when you go to the current account, we are supposed to start with the opening balances. And the opening balances are given in the question. So you are told here their current account balances. That is the current account balances of Jack and Nina. They are Jack 1.6 million and Nina 1.2 million. So those will be the opening balances for the first two partners. And then for Maria, if you go to the third point here, she contributed 1.5 for her current account. So the 1.5 million will be considered as her opening balance. So we go to the current account. We start with the balances brought down on the credit side. So Jack 1.6, Nina 1.2, Maria 1.5. Then we go to goodwill for the old partners. This is goodwill recognized. So if you go back, you will see in the first part, we credited the partner's current account to the old partners only. So when you go to the current account, you are going to credit the two partners, Jack 8 million, Nina 4 million. So for Maria, we don't have any share. Then once the goodwill is written off, we said we are required to debit the partner's current account. Jack 5.6, Nina 1.6, Maria 4.8. So this is the debit side. So on the debit side, we show the goodwill written off, Jack 5.6, Nina 1.6, Maria 4.8. So because we don't have anything else to record here, so calculate the balance carried down for each. So for Jack, it will be 4 million, for Nina 3.6 million, and for Maria, it will be on the opposite side. It will be on the opposite side, which is 3.3 million. So something you are supposed to note, since the partners use the fixed capital method, goodwill is recorded in the current account. So that is something that I had already mentioned. So that is how we normally account for goodwill, where it is not introduced in form of cash.